Yeah, bring me back to those first strategies. What were kind of your goals with those initial ones?
Both were, so the four strategies were mean reversion strategies, too long and too short. Basically, on the long side, where you look something that is very oversold, you buy it, and then you wait until it reverts to its mean. That specifically at that time really resonated with my personality. I was a lot younger, and strategies like that tend to have a holding time which is not that long, between 2 and 5 days maybe on average, and have a high win rate, which is what at that time was something that I was very, very interested in.
Mhm.
Um, I did have the same philosophy on the short side as well. So you look for overbought stocks and you sell those shorts and you wait until they revert to its mean and then you buy them back. Now, that was a very interesting time to start because it was mid 2007 and all went fine. Then in August, you saw the first kind of big tensions in the markets already. So there I started to understand drawdowns and stuff like that. And then came 2008, obviously. 2008, my mean reversion systems on the short side obviously did phenomenally well because it was a typical bear market that was violent, a lot of volatility, a lot of pullbacks to the upside that I could
And
short.
breakdown. Yep.
And so it was a very comfortable start for me during that time. And that continued until 2011. I had a very comfortable start with that. I increased the numbers of strategies, but only mean reversion, because at that time I already said, okay, I could have one strategy that has a certain algorithm, but it might be having times where it's not working. So if I have another one that is designed with some different parameters, I have some diversification. But then came the 2011 August sell-off of the market, where within, I think, a week or so, I think the index lost between 15 and 20% or something. There was some kind of Fed decision. I can't remember what. I don't look at the fundamentals. The only thing I look at is to make sure to follow my systems. But at that time, the only thing I saw that I suddenly had a drawdown that was probably more than twice as long and large as my simulated drawdown until then. Now, that, by the way, is something that is totally normal in systematic trading, but I didn't know that. I didn't have a mentor or somebody who could teach me and say, like, okay, it's fairly normal that your drawdowns could be larger. And I was like, my goodness, this is incredible. How did this happen? So I started to look at my strategies and why they actually lost money. And what I saw at that time, that obviously the lower strategies all lost money because the market sold off in a panic. And then it doesn't matter if you're diversified with 30 or 40 different stocks. If the market is in panic,
All
generally
correlations go
all
to one.
goes in
Yeah.
lockstep, all bam goes down.